Good morning, everyone. So I think this discussion will be about finance. It's an interesting year and an even more interesting year ahead. So I think we'll have to dive through a couple of verticals as we discuss the future and impacts, right? So that's, I mean, for me, COP28 is up and coming, where the question is about shaping global impacts with governments, with finance sectors, and all other kind of industry sectors that we have. And everyone knows that drastic change is ahead, not only the energy transition, the climate transition, but the also just transition from the social perspectives. So I think that gives me a huge pleasure to introduce my panelists, because we have with Amy, Amro partners, with a real estate perspective, and we have Yves with an energy perspective from the city of Vienna. So I think I'd like to kick it off straight away with your thoughts on impact and the future. Amy, Amro partners, tell us.
Good morning, everybody. Hope you enjoyed your breakfast and were thinking about climate while having your coffee. Look, impact is a big, big topic. What we're going to discuss today, I hope, and Sebastian's going to lead us through this very adeptly, is that money matters in scaling impact. At the end of the day, money is the biggest enabler. Finance, as we know it, is the biggest enabler in generating scalable impact. We all know what the problems are in terms of climate. As a real estate investor, I take my responsibility very seriously. We have about a 2 billion portfolio in the living sector. We supply homes and student housing in various markets in the UK and in Europe. And our entire portfolio is low carbon. I'll talk about that a little bit more later on. The impact that we can generate, just as Amro partners, is absolutely minuscule in terms of where we need to get as a world. We need to have $1 trillion of annual financial capability to get out of this mess. We're nowhere near that. To unlock green finance and in a way that it's scalable, there are a lot of barriers today that hopefully we'll go into and dig into. In terms of impact, we can all make impact by looking at where we put our money every day, including where we drink, where our coffee comes from. So I'd love to talk about that more. Thanks.
Thanks a lot. Lovely to be here today. So for us at Smartworks Innovation, we invest as a strategic corporate venture capital fund for the main Viennese energy provider and the Viennese public utility companies. So the way we think about impact is everything we do flows from the plan of the city of Vienna to be net carbon zero by 2040. And all the investments we do and every strategic project that the Viennese energy authorities do has to flow from that goal. So to bring that impact to fruition, we need financing. I think that's obvious, and I think that's the topic that we'll go a bit deeper into. And we want to support that not only by bringing financing to the companies, but also the cooperation, the strategic value that comes with being able to work together with a large energy provider or an infrastructure company.
So I think what you've just heard Amy and Yves talking about is trillions of money being moved, having to be moved, and real estate as well as energy being two of the places that really matter. From the position that I'm having, where I'm working with the finance and the insurance sectors, they look, of course, at all the sectors with quite some, on the one hand, fear, because a lot is changing and the risk levels are in that sense rising, so prices have to go up. But all of us, we have limited resources, and the amount of change is going to be fairly big. That, of course, also is a huge opportunity, and therefore requires a lot of engagement together with governments to have clear plans, enough accountability to sort of see, are we doing what we are saying we're doing? And I think this is sort of my first way of diving with Amy and Yves into the discussion, because what I really want to understand from them is, first, their vision. What do you think you're going to really be able to achieve? Once we understand that part fairly well, and that's fairly much in line with how you would plan investments, then you think about, okay, let's hear about the impacts, right? How do we really make sure that the impacts that we can deliver, that they really land on time at the right place? And then, of course, nothing really is that easy, right? That would be the nice thing. So we do face barriers, and we're actively working on reducing them. So I think that will be the most interactive part for sure, because this is the part where, for example, where you seeking investments, where we'd be available to sort of guide you and answer some of your questions. So that's for sure the part that we'll want to engage you on. So you can already think about your questions now. But anyway, the vision part. So I don't know what the preference is. I mean, maybe let's start with the city of Vienna, right? So you mentioned the Net Zero 2040 plan. That's very specific, right? And that must be part of the vision. So talk us through that, how it works, Yves.
Yes, so the Vision 2040 is very specific, and from that flow numerous projects that are underway in the city of Vienna to get to the net zero target. That doesn't mean we are already all the way there, or we will be with the projects that we have on the way. There's still a climate gap and an innovation gap that we need to fill. But our vision is there to be net zero by 2040, and from there we see flowing down the projects that are already underway. And I think I don't surprise anyone here when I say one of the large projects there is that there's going to be a massive increase in renewable energy sources that are going to be connected to the grid. There's going to be a massive increase in electronic vehicles on the streets. And there's going to be a massive increase in regulation, in required transparency, especially on finance, but also in every other area, in terms of ESG compliance and so on. So a massive increase there in data availability and needs to implement further transparency measures. So these are three of the topics where we see massive change coming in the coming years, and where we say we want to specifically invest either to directly help with that vision, to mitigate some of the ramifications that these projects that are already underway are going to have, or to increase the transparency that we're going to have on these ramifications. So maybe to go into a bit more detail on one of those, right? So as I mentioned, there's going to be a massive increase in electronic vehicles on the streets. That's an assessment where I think, I'm not surprising anyone. I think right now we have 30,000 about EVs on the streets of Vienna. That is going to increase to 300,000 by 2030, so 10x. So we need to 10x our infrastructure. There's no way around that. And one of the ways we're doing this, we invested in a startup that has developed a novel way of doing EV charging, deriving from the problem definition of, imagine cab drivers, they wait in a cab rink, they're in an EV, and they're annoyed because the front cab drives off, and now the whole cab chain moves along, and then they have to get out, unplug, especially when it's raining, get out of the car, move the car to the front, plug in again. Solution, we need to build the infrastructure anyway, so we put a little plate on the ground, and helped by an app that the driver has on his phone, the car can just drive on top of the mat, retrofitted, the device comes out of the battery, and he can conductively load his battery automatically without having to get out of his car. So infrastructure investment helping us pave the way for a future in where we will have 10x, 20x the EVs on the streets in our cities by 2030 and beyond.
Super clear. So I think that's a vision with examples. So the example part is for sure great. If we're using any acronyms that we should be explaining, just shout, right? So I think, Amy, for real estate and Amro Partners activities, what's the vision? So start there, and then we'll go into examples.
Well, I'll go beyond Amro Partners. I think the vision has to be much larger than at company level, and I think that's the big message I'd like to give. I think an imperative part of the vision for real estate has to be adaptation. 80% of the standing stock of real estate that's going to be there in 2050 is here already. We are spending far too little on adapting our real estate to make it resilient to climate impact. And that's the reality. We're spending money on climate mitigation. So Amro Partners is spending money on climate mitigation every time a project is on the design board, we are making it carbon optimized. What we actually end up building is meeting low carbon and net zero targets that we're working towards meeting in 2025. It's only 2 years away, 1.5 years away, actually. What I would say is that with what we're seeing at city level and at country level in terms of the climate adverse impacts, climate adverse events that are happening, we've seen that climate adverse events have grown 5-fold in the last 5 decades, and the cost of managing those events has grown 7-fold. And the reason for that is the severity of these events. It's happening everywhere. Floods, heat waves, all sorts of problems are happening to all of us in all parts of the world. There's a severity element, and there is an unpredictability element. So, for example, 2 years ago, when Germany, Netherlands, etc., were hit by floods, it cost $43 billion to solve just that problem. The economic cost of that particular flooding event was $43 billion. That's much larger than any single financial, financial kind of initiative that's been taken in the world towards addressing adaptation. Cities today, municipalities, are not wealthy enough to deal with these problems themselves. We're looking at adaptation spend at lower than 10% in most cases in most parts of the world, especially in the UK, where our local authorities are really struggling because they don't have the money to do this. So from the real estate perspective, investing in adaptation for resilience is critical. And I think tech can play a massive role in actually closing that unpredictability loop by actually giving early warning signals that are improved, that are dealing with this lack of predictability that we currently have. We also need to make sure that our smart infrastructure at city level in real estate is really there, is there to cope with these crises when they occur. We also need to make sure that our GDP at city level, which is a big part of the economic loss in any of these situations, is protectable. We can't rely on insurance companies to do this for us anymore. They're walking out of the arena. So we need to be thinking as innovators and as problem solvers in the tech community to be really thinking about how we build tech for adaptation.
So I think what both of you illustrated very well is the necessity of the investor's angle to actually step back from one question and look at the higher picture now. Because both in your Vienna energy context, it's not about fixing, expanding what you currently have. You actually move towards something quite different. And you made exactly the same argument. And that's what I'm seeing, for example, when you look at players across different Asian markets. They say, look, it's all fine and good to talk about energy, but I currently just don't have it. So I'm going to plan having it in the first place. And the second thing that you start to see is probably this year is the first year where sectors and companies start to produce their climate transition plans. So you really start to see what are you really doing, which are the actions we are taking, and what therefore does accountability mean to me, right? It's really making sure to not fall into this greenwashing trap and talk about impacts, which is the second part of our discussion. How are we going to act? What are we going to really do? And I think this is very measurable, and it has to really contribute. So I think the measurability and contributing part, there's tons of taxonomies which are abstract, but they're meant to be practical. Amy, talk to us about that in a relatable context. Absolutely. With examples.
Absolutely. So I'll go through a few concepts here, which I think critical for anybody wanting to unlock green finance. I think it's very important to first, and we all know this, to unlock finance, you need clarity. You need absolute clarity because money doesn't flow where there's no clarity. This whole plethora that we have of everything about green taxonomy, SASB, TCFD, etc., it's been fantastic because it's put climate well on the map for all investors and for people who are making it, managing money. It's not been great in terms of actually driving capital. Because we've seen flow increases over the last 10 years, but they've been nowhere near required, just like I explained before, to meet our requirements as a planet for getting out of this issue. So I think the first one is what is green? Let's clarify it. let's talk about it, and let's make sure that we all agree on it. Because finance is international. I could be building a real estate asset in the UK that's financed by Japan. That happened to us just last, few months ago. We had a large Japanese institutional investor come and talk to us and invest in our projects in the UK because they could see that we were providing them with a transparency around what we're doing for being green. And they really bought into that. They saw that we had a mechanism, a tool that we've developed in-house to actually measure everything from design stage and construction stage, embodied and operational emissions, to real-time emissions, to actually seeing how the occupiers are using the building on a 15-minute basis. We can project what the utilization is going to be and what the target is versus the actual. We can optimize to say, look, we are trying to optimize for everybody to use their washing machine when the sun's shining, for example. There's lots that tech can do. The transparency and the consistency of those metrics is critical. Otherwise, finance doesn't flow. That's one thing. The second thing is we really got to understand here about what we're talking about. And I like talking about this concept called double materiality, and I'd like to explain it in some detail. And I'm sure people in the audience will have come across it before. It's the concept that, A, we are all interested in where our money, whether the money that we've already invested in, or in the assets that we've already invested in, are climate friendly. So that's the first part. Investors around the world want to invest in ESG badged assets because they think that that's the right thing to do. They think that's the climate resilient thing to do, and that they think that the fund managers who are managing the money for them have considered non-financial risks related with climate, environment, etc. That's only one part of the deal. The second part of the deal, which I and other real estate investors are critically analyzing, because that's where we come in, is that we can make a difference as to where money is actually spent. The materiality for us as real estate investors is to say we are investing only in low carbon projects. Now that can happen as an individual investor level, that can happen at a sector level, and that can happen at an industry level, at a city level, and at a country level. All of those investments actually together make us climate resilient or not. So investing in passively in ESG badged assets, but also making sure that everything you do, including the home you buy, is climate friendly. That actually is much bigger in terms of our own carbon footprint, in terms of our own impact, than anything else we can do. So I'd like to reach out to all of you to say that financial flows are international. For that, you require clarity and you require creditworthiness. And you can only build creditworthiness around climate by being transparent about what your KPIs for climate are. And you also need a repayment mechanism that works, because any money needs returns, whether it's green or not. If we want to make green returns as good as traditional returns, we've got to work towards our creditworthiness to deliver those returns. So there's quite a number of complexities there, but tech can help.
So I think understanding how your investor looks at it, because he simply has to, and he also has to report in particular ways, is crucial for having the right pitch, because then you're working in the right direction. So I think with Yves in mind, I think we now have this sort of educational balance, how the investor looks at, but I think the energy transition, plugging things out, plugging new things in, for sure has other practical considerations that relate to impact. How do you sort of drive that forward?
I mean, firstly, I would like to fully agree with Amy here in that, yes, absolutely, transparency is key to drive flows. And for us, on a group and on a holding level, we try to be very transparent there by having sustainability dashboards online, by being accountable, by publishing our emissions that are not only daily, but hourly. And we are working on right now, and that's the part that's hard, on showing with more transparency how our individual investments have an impact on the projects that we're going to do in the future. And I think this is one of the real tough parts, right? Of finding out and quantifying that impact And right now, I have to say, in our investment committee, this is a qualitative process that we do, right? So we're having a discussion, and we're bringing up arguments in how those targets are helped by the individual investments, but we are not there yet in terms of really having quantifiable measures that we can nail down and that we can be accountable for then in the years down the line to measure whether we were successful or not. And I think that's key. I think tech can help on that point, but at least for us, we're definitely not there yet, right? There's still a ways to go.
I think one thing I should add that data is yesterday's problem, by the way. The real estate sector is very well known for talking about data as being a critical impediment. And I think, to be honest with you, it's yesterday's problem because we have tons of data. It's about cleaning it, qualifying it, using it in a sensible way to make it useful. Yeah.
So, I mean, if I listen to Amy, I'm not sure you might have the same conclusion. So there is something to be said in terms of where are we and where do we actually want to be and where aren't we already there, right? Because, I mean, if data, for example, in this case, actually is there, well, we act on the data and we're there. Well, it's not that simple. So, I mean, in many countries, I mean, UK market is for me one example, but I mean, across Europe and in Asia, it's the same. You have currently this what's called the cost of living crisis where prices are going up and the quest for climate solutions and their financing is number one only getting more urgent. However, finding the right price points and plugging together solutions just doesn't happen overnight, and it critically involves some orchestration and the ability to plug it together later. So there is a need to do a lot of engagement together with, say, governments, together with your own sectors, and then across sectors. So let's work out, conscious of time, very quickly how we can positively shape what we currently have as these barriers that hold us back. Because COP28 will be another of those moments where I say, well, we know we're kind of off track with 1.5 degree because we need to do much more. And we actually have the money. The money, in theory, is actually there. It's about being able to deploy it in ways that actually deliver a return, because you need to generate a return. It doesn't work otherwise as the investor. So the barrier part is something that is critical to simplify and to get faster forward. And let's use that and spin it in a way that engages the audience to sort of unlock your questions and engage with us to any questions that you'll have for us in a second. Yves.
I mean, one part about the barriers, and you mentioned the cost of living crisis. I might touch on costs more in general, right? And give another practical example on that. Because I don't think we're going to get there if we say, yes, we work on a green transition, but everything is just going to cost twice the amount. And to give a concrete example, tying into one of the visions that I mentioned before, right? We're going to see more renewables plugged into our grid. What does that mean? A lot of photovoltaic, a lot of wind farms, a lot of more individual sources of power are going to be plugged into the grid. That leads to some more unclean energy being fed into the energy system, right? So we invested consciously of that in a startup that has developed a technology that can clean that on a transformer level. And that means you implement that transformer and you don't have to use 10 more devices after your existing transformer to clean your grid and the energy that flows. So you both have a greener energy from greener sources, and you have a cleaner grid, and you have a lower cost in total. And I think this is the way forward, and that's where we have to get to have both of these things at once, because otherwise I don't think in the end we will manage it.
Super clear.
Well, I think the cost of the cost crisis, cost of living and just supply chain costs, all costs going up as they are, in my view, is a great opportunity for tech. Because in an inflationary environment, everybody looks for efficiencies. this is the perfect time, actually, for solutions to come forward where green assets can be absolutely made competitive with what I would call dirty assets or grey assets, whichever way you like to put it. In the real estate sector, we're seeing green premiums coming forward for green buildings that are built in a way that are more energy efficient. There's definitely that happening, but that's not long-term enough. Actually, if you look at it, green premiums cannot be the future. What has to be the future, if this has got to be scalable, go back to my first point about scalable, creating capacity, green should be, 100% financed in the same way as non-green. Today, green is very difficult to finance. It's more costly to finance. That should not be the case. That differential will come down as we get more transparency around what is green. We talked about that before. But equally, for example, in the real estate sector, recycled steel, green concrete, all of that is more expensive and harder to source than Portland cement and traditional materials. That shouldn't be the case. There should be enough incentives or enough disincentives, as the case may be. So the government and regulatory environment has a huge role to play in that. And there should be, like we see in Local Law 97 in the US, which is, I think, in New York, which is really effective, where every building over 25,000 square feet will be taxed $258 per ton of carbon emissions, or something really, really penal like that, which makes everybody sit up and take notice and do the right thing. So you can talk, cost is relative, and when you look at cost, you look at it vis-a-vis the alternative. The alternative, which is the non-green, actually becomes more costly than green. We're all going to end up doing the right thing. So in my view, that's the way we should be going.
That is a very good opening for discussion, because I think as we prepared, I think the one thing that we were very convinced of is that the urban center really is the place to make impacts. It's not only because this is the most investable place, but really because even in 2050, the urban population will just even more rise. So this is the part where your contributions will really matter. And I think making it visible, making the data understandable also to the investor, that has inherent value. So I promised you to be able to ask panel questions. So please do, particularly if you have investment questions for your cases.
Sorry.
You're absolutely right. I'm assuming that's addressed to me. Yeah, so one of the points I made earlier, and you're absolutely right, 80% of the buildings that will be built or will be in existence in 2050 are already built. So adaptation and spending on adaptation of the current standing assets is absolutely critical. Everything else we do is a drop in the ocean. I absolutely, totally agree with you. We're spending far too little money in addressing the standing problem. We've got 25 million homes in the UK that are gas guzzlers. They're worse than any diesel car that anybody owns because they are leaky, they're using too much fossil fuel. They're all get gas-fired and gas-heated, and they are hugely costly to the environment. We've got all our processes for making cement and concrete are hugely costly to the environment. I mean, the cement alone is 8% of the world's GHG emissions. So absolutely right, that unless we address our current stock and make our cities, and I mentioned earlier about our inability to actually deal with flooding, heat waves, all these problems that impact our built environment and have a very costly economic impact, especially when they occur in highly densely populated areas like our cities. It's a huge cost to our economies. So unless we deal with that, we're not going anywhere near solving this problem. And so that's about an estimated amount is $1 trillion a year required to solve that problem. We're not even seeing a tenth of that right now.
Yes, there's one more question.
Hi, I just have a question about how you see the investment environment in different parts of Europe. Like, what's the different levels of permissive environment for the investments that you guys are doing?
Yeah, let's do a quick round for everyone. Yeah, yeah, it's fairly easy for my angle. I mean, the demand is. I mean, there's a question on demand and supply, right? The demand is huge, that's for sure. The supply, I think, is also there. It's more a quest there to find the right kind of supply, right? Because number one, it's, for example, if you want to research real estate and you have suddenly all these new questions, finding the answers to your questions, you know, if you have a long-standing expert teams, then they know what they do. But a lot of things are transitioning at the moment. So finding all the data and the qualities to make portfolio choices is nowhere near yet. Example is, for example, hydrogen investments. There was a whole learning curve this year in terms of where does it make sense, where does it actually not make sense, when does it pay off, when does it not pay off. So I think that leads to questions. I think you primarily probably have a supply question in terms of, like, in my region, can I get enough allocation, which I think then relates to making the solutions, the climate solutions, investable and really stand out, so that the investors find and see them. And that is a different type of structural question. Yeah.
Let me just add a little bit. So Europe has got I mean, despite what I said earlier about the plethora of taxonomies, Europe has you might have heard of Article 6, 8, and 9, right? There is a lot of interest in investing in Article 8 and 9 qualified investment class assets. It's very difficult to find that sort of asset, and it's very difficult to find large pools of money going into Article 8 and 9 because of the lack of supply. Having said that, as far as infrastructure investments is concerned in Article 9, it's actually booming right now. There's a lot of money going into renewable energy investment in Europe right now. As far as real estate is concerned, we have, obviously, you know, we've got embodied emissions liabilities that would be difficult to justify under Article 9. There's a lot of work being done right now with the sort of the EU taxonomy experts in the UK, in Europe, to actually define better what Article 8 and Article 9 would mean vis-a-vis real estate. So like Sebastian said, there's a lot of demand for this and not enough supply.
If I might add, maybe from a startup perspective, from the perspective of a startup looking for funding, I don't think there's that much of a differential anymore between the individual European countries. So you might have a little bit left in the very early stage in accelerators and incubators. But even there, in the larger Austrian ones that I see and where I personally work with, they're looking for all over Europe and beyond for their startups. And if you look at the later stages, then, you know, the market has to be all of Europe or global anyway, and so investors will be willing to look at all of Europe anyway. So I don't think there's that much of a differential anymore. It's more a question of finding the right investor for your vertical. So to give you one example, if you would be in forestry in Austria, for example, if you do something with wood and with tech, then you go to Tyrol in Austria, because that's where the industry is and that's where the big incubators are. And there's some other examples. For example, mobility in Germany is very much situated in Munich, whereas others in Germany would be situated more in Berlin. So I think it's more a question of finding the right investor base, and often you have like these clusters that works for you, and then approaching them where they are.
Excellent. So I think let's continue other questions outside. Very happy to have more. And yeah, thanks for the active participation. So we'll hand back to you.